Okay. So, hi everyone, and hi Abhishek and Madhuri. So, we're going to have a very quick discussion around what I call the Kumbhakaran portfolio. And like the tagline says, that Kumbhakaran was famous for being able to sleep soundly through a lot of noise. You just could not wake Kumbhakaran. After he slept, he was like in deep sleep. So, as the legend goes, he was cursed by Brahma to sleep forever. But then Ravan interceded on his behalf, and Brahma changed the thing to saying that you'll sleep for 6 months and get up for one day, and then you'll go back to sleep. So when we are talking about the Kumbhakaran portfolio, it's about how you can, after you've set your portfolio, restructured it correctly, how you can go to sleep and then forget about all the noise, all the CNBC, Wall Street Journal, Bloomberg, Mint, Economic Times, friends at your party, WhatsApp groups, telling you, oh, the market's going to go up, the market's going to go down, this stock is great, this NFO is coming, and all that kind of stuff, right? Now, you could be asking yourself that if I don't listen to all this noise, and is it really noise or is it signal, um, then will I be badly off, right? So, that's the answer is that because of things like index funds and things which are doing a lot of work for you, you actually will not be badly off. And this is not something that people appreciate, right? So what we are saying is that if you had something simple like a fixed deposit, right? Now that is simple and you don't have to do a lot of work, right? But the thing is you lose a lot on performance. So with a Kumbhakaran portfolio, you will not lose much on performance, and you might actually do better than all the people who react and do various things, who are very active. Okay. So I'll pause here. Are there any questions on what I just said? Abhishek, Madhuri? No? Okay. So let's move on. Okay. So I want to start off with a few truths. Okay. So amateurs rarely beat professionals, but 5% do, right? So, so essentially what happens is that a lot of people feel that why should I pay a mutual fund company, right? Or why should I buy an ETF, right? An ETF is nothing but a collection of stocks, a basket of stocks, right? Because there are charges, right? The mutual fund company charges you something, the ETF charges you something. So why don't I just do this on my own, right? I'm so good, right? And I have this friend who gives me tips, and then, I can do this, right? So one of the questions that you have to ask yourself is that uh, these people who do this for a living, like mutual fund managers, people who construct indices, ETFs, and so on and so forth, what makes you believe that you can beat them, right? So if I say you play tennis and you're a reasonably good tennis player, but if you say that I'm going to beat like a Novak Djokovic or Roger Federer, I mean, people will think you're crazy, right? Right. Maybe if, uh, this Djokovic was really sick and he had like things, and maybe he was playing with one hand tied behind his back or something, then maybe you would beat him, right? But the chances are very low, right? The second thing that people don't realize is that when you transact on your own, there are charges, right? And these people, when they transact, they have economies of scale, so their charges are much lower, right? And they have some tax advantages. So for very many people, and what I'm talking about a Kumbhakaran portfolio, it's kind of based on mutual funds, right? Then it's also based on simplicity, right? Because simple portfolios tend to win, right? So what is this simplicity? So I've seen portfolios of mutual funds of people with 35 funds, 45 funds, some as high as 95 funds, you know. Now, mutual funds are already diversified. So why would you diversify more? So some people tell me, like suppose I take an arbitrage fund. I don't want to put all in Nippon arbitrage. I'll put a little in Nippon arbitrage. I'll put a little in Invesco arbitrage. I'll put a little in ICICI arbitrage because I want to spread the risk. Now, this is unnecessary in mutual funds because there is no fund house risk. If a fund house goes insolvent, you just replace that manager with another manager. So it's not like a bank going insolvent, right? So there's no reason to diversify across fund houses, right? And then you should be hiring each mutual fund to do a job, either to keep your money safe or to help you meet the market or help you beat the market, right? So, or maybe to save taxes. So all said and done, if you have less than 10 mutual funds is what you should have. If you're more than 10, you're not like really in a Kumbhakarna portfolio. So this also covers this. You can over diversify. And then you should buy carefully and sell reluctantly, right? So you can do your homework and then, of course, things can change, but then you sell reluctantly. And taxes and fees apply when you act. So if you don't act, you're not going to pay any taxes or fees, right? So if you construct a portfolio and absolutely do nothing, right, then you'll just keep getting capital gains, but those capital gains will just be unrealized and you'll pay no tax and you'll not pay any fee on STT and so on. So now, if you have everything in mutual funds, then obviously you'll need to have some money that you need to withdraw for living expenses if you're not earning enough to cover your living expenses. But if you're earning enough to cover your liquid earning expenses, then you don't even need to withdraw. You're just going to be adding a little bit of money every month to your mutual fund portfolio, right? And there'll be no taxes at all, right? Okay. So again, I'll stop here. And any questions on these truths? I can't hear. Are you on mute, Abhishek?
No, I think it's very clear.
Okay. So, like they said, that common sense is one of the things which is most uncommon. Right? So, to me, and, I also did not realize these simple truths earlier on, right? But over time, I've now come to believe that these simple truths are okay. So some Gautam Sahu has just joined us. So Gautam, you have to see a little bit of the recording, but you carry on and ask any questions. So what we've covered so far is that we've talked about this concept of a Kumbhakarna portfolio where you set your portfolio and then you go to sleep, right? So you don't listen to all these things that the market is going up, the RBI is changing interest rates, Federal Reserve is doing this, Trump is going to get elected, Modi may not get elected, may get elected. You're not listening to all this. And we just covered this thing about a few truths, which is there on the screen. Can you see the screen? Oh, I don't know whether he's been able to join or not. Okay. Anyway, we'll carry on.
I can see the screen.
You can see the screen? Yeah. Okay.
Yes.
So do you have any questions on these, what I'm calling the few truths? You can just read them.
I have I've taken membership of that Bharosa Club,
Okay.
and a few of the recommendations I see for my portfolio that, it says to, instead of investing in the actively managed funds, to invest in passive funds, right? All Nifty 100,
Yeah.
small cap, and all.
So actually, Bharosa does not, it gives you insights. It doesn't give you advice, really.
Yeah, of course.
Yeah.
Yeah.
But the thing is, yes, it shows you that active funds cost more than passive funds, but and their performance may be better and worse. They may be able to justify their fees, or they may not, right? But basically, so you could consider three buckets. One is a safe bucket, another is a meat bucket, and the third is a beat bucket, right? So where you're trying to beat the market, meet the market, or keep your money safe. And then in Bharosa, if you look at the investing playground and you look at the bundle in the 1 to 3 year category, there's an arbitrage fund, which is very tax efficient. So when I was an advisor, I used to and I had advisory clients, I used to more or less recommend that they keep their safe money in this arbitrage fund because it's very tax efficient. It gives equity taxation. So instead of having short-term corporate bonds, this, that, the other, and lots of debt kind of stuff, whatever you want to keep safe, just keep it there. And then you have Meet the Market, where you're essentially trying to replicate the Nifty 500. So there were three funds, which replicate the Nifty 500. And why three? And why not the Nifty 500? Because there's a slight expense difference, And then on the beat, you could do multiple things. You could be outside mutual funds, you could buy crypto, you could, but if you wanted to do in mutual funds, then again, there are choices of active funds and index funds, right? And explore funds on Bharosa can help you with that. Okay. So anyway, so we'll move on to the next one, the slide. And okay. So building a Kumbhakarna portfolio, right? So now Bharosa has recently introduced this thing where you can check your portfolio health score. Now, this is a very interesting thing because if you really read through the methodology and all, it's been done in a very intelligent way, right? And it compares your health, your portfolio's health, to the health of other Bharosa members. And this will keep changing, right? So if other Bharosa members make their portfolio better and you don't, then your health score should worsen. Or if you make it better, then it should become better, and so on and so forth. So, and moving it is not that simple because it takes a look at your last 3 years, right? So if you've taken some actions now, it may take some time to reflect on the health score, but it generally gives you an idea on how are you doing on fees, how are you doing on picking funds, are your active funds beating the benchmarks, or are there funds beating the benchmarks, and on your bets that you're taking. So are the bets that you have taken, are they beating a simple portfolio? Okay. And so if you understand safe, meet, and beat, right, then you can build a Kumbhakarna portfolio. And what we're talking about a Kumbhakarna portfolio is you build a portfolio and then you go to sleep, right? Then you get up once a year, maybe, right? And then you rebalance your portfolio and the things. So safe and meet, like I explained to you, are very simple. Beat is the tricky part, right? Because you might want to invest in real estate, you might want to invest in single stocks, ETFs, mutual funds, whatever, right? But if you look at mutual funds, there are some index funds where you've got a return, at least in the last year, of as high as 90%. Right? Now, explore funds on Bharosa can help you find those and things like that. But, so those exist. But there are, of course, single stocks which have given you, like in some cases, even 300%, 400% in a year, right? But picking those is hard, right? So once you've done this hard work of picking your things. And it's not necessary that this particular index fund, which was a somewhat smart index like the S&P BSE Enhanced Value Index, though it's performing very well so far, it's going to continue performing, right? That's not a given. But if you look at the way the index is constructed, you get convinced and you pick it, then give it time. Wait for a year and see whether it's performing, whether something has happened, etc., etc. So typically you can take like maybe the month of March every year, because that's just before the financial year ends, and spend that in being awake and looking at your portfolio, and the rest of the 11 months you enjoy, right? Okay, so Abhishek, Madhuri, Gautam, any questions on this slide?
No, all good.
No, you're good? Okay. So this ultimately, the goal is zero financial anxiety, right? So what you have is that some people will come and tell you, oh, what do you do? And you tell them like, no, I have few mutual funds and I got index funds and I have a few funds which are active. And, with this, I think I'm good. So then they'll say, hey, that's not right. I mean, like you're missing out on so many things. There's guys saying this is going to happen. He's such a good this thing. But if you have quiet confidence, right, then you'll say, that's fine. But, I've chosen to do this and I look at my portfolio once a year. So I'll absorb all these things that you're telling me. And, then I'll see whether I want to act on them or not. The biggest thing that you have to worry about is that this FOMO, right? Like the fear of missing out, right? And sometimes, like with any rule, there are exceptions, right? So if you feel that there's some great IPO coming, or you have a great opportunity to invest in some startup, your friend is doing a startup or whatever, or there's a piece of distressed real estate that you can pick up, and so on and so forth, you may break your sleep and get up and do something. But in most cases, just because somebody tells you that, oh, I have this opportunity to buy SpaceX stock and it's unlisted and, I can get you a deal where you can participate, you might say, that's fine. It doesn't fit into my portfolio and I'm not afraid that I'll miss out some big opportunity here. Right? And then you focus on things that matter, right? So if you put your portfolio in this Kumbhakarna state, then you can focus on other things, things that really matter, because money is just a means, it's not an end, right? And you can achieve true financial independence. So that is all that I had to cover in this session. But now the floor is open. So any of you want to make comments or say what you took away from this, etc., please feel free, and we can have a brief Q&A and otherwise end the session.
Thank you for this, Sanjay. So let me kick off one question. So look, I have had the privilege of having a very clean, simple portfolio construction. Obviously with your help. But I know people who've been missold, who bought into things that are not great products. Sometimes there is also anxiety and stress about, okay, I've already invested in this. Let that continue. But I will now, from this point forward, I will build something which makes sense. So a lot of times in those missold products or bad products, they'd be deeply invested. And there is also this anxiety and stress about, okay, how do we exit out of it and things like that. So how do you see they should plan their way out of it, or go from a bad portfolio to a Kumbhakaran portfolio?
Yeah. So there are two things that I have noticed when I've talked to people, right? So one is that they don't have all the information, right? So the first step is to gather information. So what are the choices available to you? So one of the places where there's a lot of mis-selling is insurance. So people are into bad insurance products, right? Now, very many of them don't understand what their options are, right? So they could, of course, surrender this, but then there may be some draconian penalties on surrendering that insurance product. Now you can always do a cash flow analysis, like on Excel and XRR, saying, okay, if I surrendered this, I got so much money, I reinvested it in, say, these simple products, the Kumbhakarna portfolio. Then what would be, say, the terminal value after 5 years or 10 years or whatever, right? And that may help you make a decision. But then there are some other choices where you can make a policy paid up, right? So you don't pay any more premiums, your benefits reduce, and so on. So one is getting that. Then some people get stuck in PMSs, like these portfolio management schemes. And if the portfolio management scheme is not doing well, or you decide that I don't want a PMS, then each portfolio management scheme may have different ways how you can get out of it and stuff like that, right? Then people get stuck on saying, okay, if I got out of it, where will I invest the money? And there may be tax implications, on getting out. No. So you'd factor all that, but this question of where you will invest the money, people find great comfort in, oh, I can always invest it in this Kumbhakarna portfolio, right? Then there are certain product classes like some alternative investment funds like AIFs and things like that, where you just can't get out. Like you're stuck, right? Or some closed-ended products where you can't get out, right? So fair enough. Then once you realize that, then again, you have no anxiety, because fair enough, you made a mistake, you can't get out, then stay with it till it gets sorted out. Like some people have had invested in, say, these ultra short-term debt portfolios, which are supposed to be very safe. But then there was some credit default, and some of their money was put into a segregated portfolio, right? Now, they'll ultimately sort of get their money back, but it may take some time, but there's nothing they can do on that segregated portfolio. They can't get out of it, right? So that's the kind of question of how you got to deal with. Then there are also things where, you may have too many illiquid investments, right? So if you have a lot of land, you have a lot of property, you have a lot of investments in startups and things like that. So one you could say is, okay, I'm going to try and get out of this as I can, but the other is I'm not going to invest more in these illiquid instruments, right? Unless there's some really good opportunity, which I've thought about very carefully. So that's the way you've got to sit and analyze it. And if you look at some of the previous sessions on this, things like your balance sheet and all those kind of things, that may help you. And then you can talk with an advisor, okay, who will help you sort out if that person's a good advisor on what you can do, cannot do, if you can't do it yourself. Right? Does that answer your question?
Yes, thank you.
Yeah. Anything else that pops up on this thing? So do you think like this Kumbhakarna portfolio is something where if you did something so simple, would you miss out on return?
No, I don't think so.
Yeah.
I don't think we do. In fact, I just wanted to highlight this, Sanjay. Now that the election season is on and a lot of people are getting nominations for MP elections and things like that. So I've been reading the affidavits of some of these politicians, and I see that. I mean, one example is there's a politician, my MP. He has invested in 26 mutual funds. And if you see, there are like 7 mid-cap funds and 5, diversified funds, and it's all a mess. And I was just thinking about the same thing, yeah, I mean, he doesn't have to invest in 26 funds. He can probably be in 4 or 5 funds, which would perhaps give him the same return, if not better.
Yeah.
And this is a
So,
trend that I'm seeing, right? I mean, a lot of these politicians,
see,
it looks like they don't have
so
good financial advisors.
yeah, so what I think, some of the advisors are scared of is that if they tell you it's so simple, then you say, why do I need you? So then in some ways they're hitting at their own bread and butter, but that's not really correct, right? Because when an advisor really adds value is like when a market goes down, you're panicking, right? You're saying, oh my, this thing, I need to sell. The advisor says, no, relax. I'll show you data. This has happened before, right? Stay there, you know. So the advisors like tend to tell them that, oh, this new fund has come, or this fund was not, but I'll tell you a better one, you know. So that is why, and then they try and say, okay, out of these 7,000 mutual funds, I picked 26. Right? Like, so if you say, okay, I picked 4, 5, and it's so simple, then, people are very suspicious of simplicity. Because I've had people, when I've advised them, saying, अच्छा ये तो ठीक है, पर अभी कुछ नया बताओ ना. Saying, what naya do you want? Right? Okay. So anything else?
No.
Okay. Madhuri, do you have any questions?
No questions as such, but if I can just add on to what Abhishek said, which is having 26 funds and having your money invested in like these multiple things. I think it mainly stems from the fact that we are always told to diversify. And people think that diversification means that you make it as complex as possible. I think a lot of times we tend to lose sight of the fact that the more complicated you make it, the more time you need to spend. You need a dedicated set of hours to actually like review it, and no wonder you can't just leave it alone, right? Whereas when you simplify, it's definitely something that works, especially for working professionals who also have like 20 other things that they always have to do. Simplifying, of course, sounds counterintuitive based on all the advice we get, but I think it's definitely the smarter way to do things. So I completely agree with the whole set it and forget it, concept of things, especially for things where you need to stay on for the long term to see real results. So in such a scenario, yes, I completely agree with this approach rather than anything else.
Yeah. So that's a great point. And, like now some of the funds which are becoming very popular are these things called multi-asset funds. So where you're putting a little bit in gold, a little bit in silver, a little bit in, some other asset category like real estate, and some in stocks and some in gold, all these kind of, right? So other commodities, maybe nickel, platinum, whatever. Yeah. So then people say, yeah, this is now diversified, right? In terms of this. Now, I have found that, and this may be a counterintuitive view, but my thing is that, like, if you just stick with equities, I think you'll just do fine. Because a lot of these things ultimately get reflected in equities. So, like, even for a little while, I did buy a little bit of Bitcoin personally, but I bought it through a stock. So there was a stock called MSTR, MicroStrategy in the US, which owned underlying assets for Bitcoin. So I could express my Bitcoin holding or desire to hold Bitcoin through a stock, right? And now there are ETFs and various things which are coming up. So, like in this whole beat category also, how you look at, figuring out where you want to try and beat the market. Okay. And how you can do it simply is worth considering. And at least personally, the biggest mistakes I have made are not from, are trying to diversify. I mean, like, for instance, had I not sold a single share of PayPal, like I was on the founding team, so I had a lot of shares, I would have done phenomenally well, much better than I have done, right? But with the wisdom saying, okay, now you've already made this huge gain, so now spread it and diversify and put it in other assets. So, so that's an example of where following the diversification thing didn't work. Sometimes it could work, right? You may be in this thing, but that's ultimately your choice. But you can't just take this conventional wisdom that diversification is always good, right? And mutual funds actually give you a pretty diversified thing. So, like, if you've seen a duck, in a pond, right? It looks so serene, right? There's nothing happening. It's just floating peacefully. But underneath, there's a lot of churning of the legs to keep that thing afloat. So that's something like index funds, right? Like now, index funds, if they're investing in 500 stocks and the market capitalization is changing every day, they are adjusting, to meet the market capitalization as it stands, right? You don't see it. There's no transaction for you, which is somewhat the beauty of index funds. So there's a lot going on under the surface for you. Okay. Anything else, Madhuri? Okay, Gautam, do you have anything?
Not right now.
Okay.
What the only thing is, even after joining Barosa, and has recommended something, it has been, found it very difficult to, churn it, sell something and buy. So I didn't have any index funds earlier. So I did start some SIPs and index funds, but I've been very slow and,
Yeah.
No,
so
it's
you should
always
do
a
it.
very,
Yeah. So you should do it carefully. And if you are not adept at doing it yourself, then consider using a flat fee advisor or a distributor, whatever you're comfortable with. But the basic logic is like this, right? So let's say you have an active fund. So you're paying 1.5% or whatever you're paying. And if you put it in an index fund, you'd be paying 0.3%. So you're saving, or 0.4%. So you're saving like over 1% annually, right, on that money. So that's fine. But the thing is that if the active fund is beating the index, then you will lose out on performance, right? So one of the things that you have to see is that, is this active fund beating whatever you want to invest in, right? That's number one. Let's say it's not. So now because the fee is already factored in when you're looking at the performance, right? So don't double count. So now you know that, at least based on past data, had I invested a year ago in this fund index basket that I'm thinking of, then I would have been this much better off, right? So that gives you a data point. But you're thinking about the future, because this fund, whether it was doing badly, could turn around, right? You don't know that. So that you'll have to make an educated guess. But the other thing is that, these things which are already there in Bharosa called Paisa Vasool Insights, I don't know when you uploaded your portfolio may. So that really recounts all that and tells you what the thing is. So that's a decision model framework that you can use. Now, I know that the team is working more on the WhatsApp thing that they've launched. Are you using the WhatsApp stuff?
No, not yet.
Oh, okay. So you should log in and link your thing to WhatsApp, and this portfolio health and all that I was talking about. I think you'll find it very interesting. Okay.
Okay.
Yeah.
Huh.
On that note, Sanjay, I started using it. It gives very specific, simple to understand, bite-size insights on my portfolio. So
yeah,
I was very happy that it's a lot easier because it's on your phone rather than I don't have to go back and log in and explore. So I love this feature. Thanks.
Right. So I think you'll find that interesting. And also they're working on these improvement opportunities, right? Which will give you very specific pros and cons of staying, or acting. So they probably will not highlight something to you unless they think that there is something that you need to think about, right? But they'll give you all the merits of getting out of it and possibly why you should stay with it, right? Because they're not like really giving you advice. But so I personally think that this personal finance is not rocket science, But I have seen like bankers, like finance executives, etc., not doing very well on their personal finance or having difficulties understanding it. And you have software engineers, you have like other professionals, etc., who solve very complex things, like artificial intelligence and all this kind of stuff. But they find it difficult to understand these financial concepts, But I think that's more because they don't want to spend the time to understand it, because it's not that complicated, right? So I would encourage you, and then if you actually work with an advisor also, then say if you have a contract for 6 months, 3 months, 1 year, then you can learn a lot. And then if you don't need that advisor, you don't need to keep paying that advisor, right? So one of the reasons, like I was a principal officer of the advisory division, and one of the reasons I stopped taking new customers or renewing other customers was that I felt that from whatever I've learned, if we add these templates, which I'm doing in this series and all those kind of things as tools onto Bharosa Club, where people can use this themselves or with their advisors, that may be better, rather than are trying to be an advisor. Because there's so many advisors out there already. Right? And personally, I feel that, like I said, that it's quite possible for quite a few people to be their own advisor. Like if you are in the medical field, not too many people will tell you be your own doctor, right? But in finance, it's not that critical. So being your own financial advisor is not that bad, but you can learn, and talk to people and ask your advisor intelligence. Like the Sharmila Tagore and Soha Ali Khan and my wife Anita did a podcast, which I thought was excellent, because they said, yeah, even if you're using an advisor, ask them questions saying, why am I in this fund? Right? Now, this is basically losing me so much money. This is a fee. This is the thing, why am I in this fund? Should I get out? If I get out, how much tax will I pay? So the whole idea is that if you become informed and you say, I want to move to a simple Kumbhakaran portfolio, right? Like, then the person, and you say, okay, if you are trying to audition these advisors, you pick an advisor who says, yeah, I'll help you move to this Kumbhakaran portfolio. And I realize that once you are in this Kumbhakaran portfolio, you may not need me, or, my fees are, so when you renew with me, I'll charge you a very small fee. So maybe, you need a second opinion or you want to bounce off something off me and stuff like that. I can do that. But fair enough, because I'm not looking to make a large amount of money from a small number of customers. I have plenty of customers. And if the customers are well informed and they don't take up too much of my time, then, great, I can service more customers. Right? Okay, so I'm just going to stop sharing this thing. And okay, so any other questions? Otherwise, we can kind of wrap up this session. Now, I would encourage all of you who haven't seen these sessions to go over as many of them in the playlist as you can. I know they're long. You may not agree with many of the things, but some of the things might be useful for you, like the wealth index or asset allocation or making a balance sheet or whatever. So at whatever speed you do them, with these series, what I'm trying to share is some things that have worked for me. That doesn't mean they'll work for you, but you can adapt them, to make them work for you, right? So that's the purpose. Okay, so should I end the session?
Yes, thank you, Sanjay. Thank you very
Okay,
much.
thanks.